This is episode 3 of the Average Investors Podcast. Hey everybody. So I know the audio in the last episode wasn't as great. I was experiencing a few technical difficulties with the audio rendering, which is a bit strange for a software engineer that I'm struggling with tech, but we're going to make sure to improve it and keep going forward. So now let's get down to business. Now, I know a lot of people listening to this may be a little bit scared and timid when it comes to investing. They may not have a lot of money to invest or feel as though they don't have any money at all to invest. But what if I told you I got a few tricks that I can share with you guys to help increase the amount that you might be able to invest or the amount of money you may have to invest? Now let me share them with you guys. First off, it all starts with your mindset. Now what I mean by this is that when you get your paycheck, don't spend first to go buy your new pair of shoes or a new phone or new headphones or whatever it may be. Take that paycheck, immediately put some money aside. You have to treat investing as though it's a bill or a tax where you just can't avoid paying it. If you do this, I promise, even if you start small, even if you start off as it being about $10 or 15 or 20, whatever it may be, trust me, it will add up. Now, I know we haven't started investing yet, but put this money to the side. Because when we do start investing, you're going to really want it there. Now, the second one is start picking up side jobs. So let's say, and it doesn't have to be anything complicated. Now, for example, let's say you go grocery shopping. Well, you can become an Instacart shopper and you might as well go and pick up a few extra things for somebody else while you're there and doing your own shopping. So that way you can at least make some money off of it. This is honestly a great idea and you can do this with so many other things. Now, DoorDash or becoming Amazon Flex driver if it's available in your area. This will allow you, well, let's say you're just bored sitting at home or you want to go get some food for yourself. It'll allow you to go and make some money while you're doing something you were already going to do, or do something while you don't really have anything to do. Now, the third thing is to honestly stop buying coffee outside. Learn to make a good cup of coffee at home. And if you drink lattes, get an espresso machine. Get a Breville espresso machine. The lowest one's good enough. And honestly, you need to buy for about $250, $300 and you're going to save a ton. Now, I recommend this for people that are going and drinking a cup of coffee every day from Starbucks, where they're spending about $4 to $5, whereas they can make that same thing for about 20 to 30 cents at home. And I've seen a lot of people that are wasting so much money on Starbucks, whether it's about $10, $15 a day, and they're going almost every single day because they don't just drink 1 cup or 2 cups, but sometimes 3. Whereas you can just save that money, or even better, just give up the habit. Save that money. You'll have so much more money left aside for your investing, and perhaps if you do have some debt, to pay down your debt. Now, the fourth lesson and fourth tip I got for you guys is honestly, look at your cell phone plan. Reassess it. Go see how much you're paying. Go on Craigslist, go on Kijiji, go on any of the cell phone providers, the major ones in your area. See if you could get a better deal. Because I'm sure at least half of you are overpaying for your cell phone. So go on Craigslist, go on Kijiji, if you're in Canada or the US, and see if you can get a lower plan. That will save you every single month. Because you'd be surprised at how many Canadians are paying over $100 a month for their cell phone bill when they can easily cut that down to $50, $60. Now, ultimately, what I'm trying to do is make sure that those that don't feel like they have enough money to invest, I want to give them ways where they can start figuring out how they can invest by making a little more, by saving a little more, and just getting creative and smarter with how their money is being spent. Now let's jump back on with some investing knowledge. To start off with, I want to talk a little bit about bonds. Now, I'm sure a lot of you have heard about bonds, but just aren't quite sure exactly what they are. Well, a bond is a fixed income loan that is issued by companies and governments. Now, what that means is companies try to raise money through bonds where they will pay a fixed amount over a certain amount of time, such as 10 years. To simplify that, let's go back to our pizza example. Let's say you want a pizza, but you can't quite afford it. So you make a deal with a bunch of your friends to borrow $1 from each friend. Now, that dollar will get you one pizza slice. You will in turn promise that you will return their money in 1 year while giving them 2 cents every month just to keep them happy. After 1 year, you give back the original dollar to each friend that gave you the money for the pizza slice. Now you're probably wondering, this sounds quite similar to stocks, but let me tell you how bonds and stocks differ. Well, bonds and stocks do differ in one major way. Bonds are where you lend the company money, like a loan, where you will receive interest on it. Stocks, on the other hand, are where you own a piece of the company. Now, how are bonds similar to stocks? Now, bonds and stocks share many similarities. One of them being that bonds are traded on the bond market, just like how stocks are traded on the stock market. Now, bonds also share similarities in the sense that they're both used as vehicles for companies to raise capital. Although stocks do it by selling a piece of the company, and bonds do it by giving a loan to the company. Bonds can also fluctuate in price compared to the initial value that they were created and sold at to the public. Bonds can also be traded before the maturity date of the bond, where the money is to be paid back to the lender by the company. Now, bonds do have one big challenge. Because bonds have a fixed income payment to the holder of the bond, they could possibly lose money due to inflation. So let's say the bond returns 3% over a year, but inflation causes everything to go up by 4%. Technically, you'll lose money because the buying power of your money that you may have even gotten some good interest off of is less than the price that things have gone up. So now this may be a little convoluted and hard to understand, but let me explain it in simple terms. Imagine you sold a pop can for $1 and you gave your friend that $1. Now, after a year, your friend gives you back $1.10 in return. But now when you want to go buy that same pop can, it now costs $1.20. You may realize this with a lot of things. When it comes year to year, things tend to get a little more expensive, meaning that your dollar is now worth less and less each year. That's what we call inflation. And bonds can greatly be affected in the sense that if their return is less than the cost of inflation, is less than the rate of inflation per year, then essentially you've lost money. Even though you may look like you've gained some money, overall you have lost some money. Now don't fret, as bonds tend to do very great in years where we have deflation. Now that means that things have actually gone down. Your buying power has now increased. Now this is greatly due to the fact that now that your bond has matured, you have more money on hand than you did a year ago. And your money can now buy you more than it could a previous year ago. So this is kind of like a double whammy, as you've gained some money and your money's now worth more. The next thing about bonds is that depending on the company you're lending money to, you might not get your money back. Now, bonds are graded based on the company you're lending money to's ability to pay it back. Now, the grades range from AAA to D. AAA being the highest and having prime credit and ability to pay it back, D being defunct and not in a great position to pay anything or survive as a company. Usually companies with a higher grade will pay less in interest and they are more stable. And those with lower grades will pay more as the risk that the company not paying back the money is a lot greater. Now that about wraps up an introduction to bonds. Let's move on to the next topic, which is ETFs. Now, a good example of this would be, imagine you're hosting a party and you're not sure what everyone wants to drink. So instead of just buying one type of drink, you go out and you buy whiskey, rum, vodka, tequila, beer, pop, water, juice. This way, you at least know that somebody, if they may not like a particular drink, they have options. And you'll most likely have all your guests happy with and having a good time. Now, exchange-traded funds, or ETFs for short, are essentially a basket of securities. You may be wondering what securities are, so don't worry, I'll explain that to you. Securities, for those who may not know or may be familiar with, are any investment that can be traded. So this can include houses, stocks, bonds, oil, any kind of commodity at all that has financial value that can be traded. Now, back to the topic about ETFs. ETFs are a basket of securities that can be actively managed, stocks, which are managed by a team of professionals. They can be a commodity such as gold, silver, or even oil. They can follow an index of a bunch of stocks such as the S&P 500, which are the top 500 US companies by value. They can follow a sector such as banks, tech, or medical, or they can follow foreign markets such as China or India's markets. ETFs are essentially a basket of different stocks or commodities, and they are designed to essentially allow the public to spread their risk by not exposing themselves to just one type of company or commodity. Now, let me explain some of the benefits of ETFs. Now, some of the key benefits to ETFs are that they are a great way to invest in certain sectors, as they allow the holder to diversify and not be exposed to just one company. This will allow the holder to minimize the risk of owning a company that may not perform well compared to companies that are in the similar sector. So this means that competitive companies that may perform better, well, you won't be taking a hit on perhaps a underperforming company. The next benefit to ETFs is that they provide a lot of convenience. For example, the S&P 500 allows you to have a fund of the top 500 companies in the US. Tech ETFs allow you to hold a position in many big tech companies such as Microsoft, Apple, and Salesforce. They are also weighted based off of market cap. For example, the S&P 500 is made up of 5.9% of just Apple, which is one of the largest holdings and is the most biggest company by market cap in the world. And a smaller market cap company in the index, such as Fox, makes up only 0.04% of the index. The next benefit is that ETFs allow you to take a small position in a company which may be too expensive to have a position in as an individual stock. So certain companies such as Amazon, which trade for over $3,000 US, are way too expensive for a lot of small investors to start a position in. So ETFs allow you to have exposure for a lot less. Now, some brokers do allow fractional shares, but not all. So this is a benefit for a lot of investors, where their brokers may not allow fractional investing. The next benefit is avoiding fees in buying too many companies. Usually, a lot of brokers charge a broker fee to buy stocks, and each company you buy into will be an additional fee. So that means each time you do a transaction, you could be paying a fee. But with ETFs, you can buy into a bunch of companies and only pay one fee per transaction. AMD and other tech moguls. Well, you can buy into that ETF that encompasses all those with one fee. Just one-time fee. So let's say you buy into a tech one, which may encompass Apple, Amazon, Microsoft, Salesforce, Now, these are all the benefits to ETFs, but what are some of the drawbacks? For starters, your gains are still not guaranteed, as they can still be affected by market conditions, such as oil ETFs, which during the quarantine had seen massive drops in value due to less air and car travel. The next is possible currency risk. Now, for Canadians holding US ETFs and looking to sell them, now would find that the stronger Canadian dollar will result in a loss. This means that if you're holding securities in foreign markets, the conversion rates will have an effect on your return during sales. ETFs usually do have a MER, which is a management expense ratio. So this is the fee that is paid to the individuals that manage the fund. This might be small for certain funds, but they will take away from your returns in the long run. Certain ETFs may also be highly leveraged, which could have implications, as the fund can be very volatile to becoming defunct. The last is that they may have certain tax implications. With an ETF, you may have or be interested in acquiring. Now that we have a high-level overview of bonds and ETFs, let's get into something many of you may already have: mutual funds. Now, a lot of you that are investing might have these in your portfolio, or have thought about getting mutual funds. In fact, your work may offer these, but how well do you actually understand what you have and the possible fees you're paying? Well, to start off, mutual funds are investment portfolios that are professionally managed by experienced account managers. They are pretty much many investors that are pulled together by a company to purchase securities. They can be a mixture of stocks, bonds, real estate, commodities, ETFs, crypto, and even other funds. They are truly a mixed bag of securities. When purchasing mutual funds, you are paying a price per share of that fund, much like ETFs or individual stocks. Mutual funds, as an easy example, is like Walmart. They sort of carry anything. Even like how Walmart has other stores in it, such as McDonald's. Mutual funds can even have other mutual funds in their fund. Mutual funds are in fact the most popular investment in America and Canada. Now, let's go into some of the benefits of mutual funds. For starters, mutual funds allow investors at every spectrum to have diversity. Due to the ability to buy mutual funds at any price range, as they can be fractional, that means fractions of the fund shares. This means that if a mutual fund is $20 a share, you can start buying it at any price, whether it's even $2, which is only 10% of a share. This has benefits as you don't have to wait to have enough money for a whole share. This allows these investors to have a diversified portfolio even if they may not have all the money to buy a share at a time. In turn, any dividends you also get on your mutual funds can be reinvested easily to purchase more shares. Now, the second benefit is you get to pool your money with other investors to allow the fund to make major acquisitions and bigger moves, as they now have a lot more capital at their disposal. This would be similar to pooling in with family and friends to buy dinner rather than trying to buy dinner by yourself. It allows for easy access to foreign and private equity markets, as funds have more tools at their disposal than an individual investor would. Mutual funds also have access to professional money managers that watch over the fund. They are also fantastic for those that don't have enough time to manage their own portfolio, much like how a property manager would manage your properties. Now that we talked about some of the advantages, let's look at the other side of the coin and talk about some of the disadvantages to mutual funds. The biggest disadvantage to mutual funds that most aren't aware of are all the costs. Mutual funds have what is called a management expense ratio, or MER for short. Now, a lot of you that have mutual funds might be overlooking the price you're paying management to look over the fund, the cost of operating the fund, and the taxes associated with the fund. Now, let's say you put in $50 into a fund every month for 25 years. and this fund has a 2% MER, and the average return is 11% per year. After 25 years, you will have roughly accumulated $87,000, often just putting in $50 each month for 25 years. But you would have lost $13,000 due to fees and the gains you would have made on that money over those 25 years. So that 2% after time starts having a very drastic effect. The next downside is that mutual funds don't allow you to take a higher exit or lower entrance price. They do not have flexibility in timing your purchase or selling of any fund shares. This is because they execute at day's end, and everybody that purchased before the day's cutoff get the same price. This is a disadvantage to active investors, but on the flip side, it is an advantage to those that are not active. The last disadvantage is bad management. Certain managements may try to manipulate and misuse the fund to achieve their own yearly or quarterly targets, instead of looking at the bigger picture that would benefit investors. This may be exiting positions that are down just to reach results, or excessive trading, or even just changes in management that lead to changes in strategy. Sometimes putting your money in other people's hands is not the best choice. Now, that gives you a high-level overview of mutual funds and how they can truly be a all-in-one package. Mutual funds are what I believe are great for the non-active investors, but please look into the details and be aware of what you may have. I myself, as a disclaimer, do not have mutual funds outside of what is matched by my work. Now, it's time to wrap up today's episode. I really hope you guys enjoyed and learned a lot. If you haven't, please make sure to follow the podcast and share it with your friends or family if you believe it can help them. Thank you guys so much for listening, and if you have any questions on today's topic or any past topics, or any topic you would like me to talk about, please send an email to averageinvestors@outlook.com. It's in the description if you're looking for it. Now, thanks and stay tuned for episode 4.